The roots of electronic money reach back to 1983, when David Chaum proposed eCash, an anonymous, digital alternative to physical coins. For decades, the idea lived on the internet's fringes, until 2009, when anonymous developer Satoshi Nakamoto mined the first Bitcoin block. This launch promised a decentralized utopia. The goal was simple: create a financial system that didn't require permission from a government or a middleman, effectively removing the greedy traditional banks from the equation. To early adopters, this was the digital middle finger to a corrupt financial establishment, a promise of absolute control over one's own wealth. Decades later, that revolutionary spirit has largely short-circuited. The space is now dominated by aggressive hype cycles, anonymous rug pulls, and a culture of get-rich-quick schemes that feel less like a movement and more like a desperate hustle. When you strip away the technical jargon, you find an ecosystem that functions as a massive siphoning machine, a structure that critics and observers increasingly view as the single largest scam of our generation. To understand how a digital utopia turned into a graveyard of bankrupt dreams, we have to conduct a structural audit of the industry's 4 primary layers. We start with the industry's North Star, Bitcoin. After 16 years, the primary metric of its success, widespread real-world utility, remains remarkably low. Out of roughly 350 million businesses worldwide, only about 18,000 actually accept Bitcoin as payment. In the context of global commerce, that is an invisible speck on the map. The reason for this is structural. While the U.S. stock market averages about a 15% annual volatility rate, Bitcoin sits at a jagged 60%. Between that volatility, high transaction fees, and constant fraud, using it as a currency is like trying to mow your lawn with nail clippers. This lack of stability is why institutional money managers generally avoid it. Warren Buffett famously dismissed the asset, referring to Bitcoin as rat poison squared. Jamie Dimon, CEO of JP Morgan Chase, was even more blunt, categorizing the asset as a pet rock that does nothing. Without utility as a payment system, Bitcoin exists solely as a speculative asset, one whose value is based entirely on whether someone else is willing to buy it for more than you did. Moving deeper into the market, we find the world of altcoins, alternative cryptocurrencies that retail investors treat like a high-stakes roulette table, hoping to find the next big winner. The math is brutal. Since 2021, CoinGecko has tracked over 7 million coin listings. Of those, over half have already stopped trading. Millions of individual projects have simply gone to zero. In the stock market, bankruptcy involves a legal process of asset liquidation. In crypto, failure often takes the form of a rug pull, where the creators drain all the value and vanish, leaving investors with nothing but a dead Discord server. This isn't a landscape of innovation. It's a graveyard, where more than half of all projects are statistically guaranteed to disappear overnight. To combat the industry's volatility, developers created stablecoins, digital assets designed to stay pegged to the value of the US dollar. They were marketed as safe harbors, similar to a digital savings account. Terra was a prime example. It used an algorithm to manage its sister token, Luna. If Terra's price dipped, the system minted more Luna to prop it up. If it rose too high, it burned Luna to bring it back down, theoretically keeping the asset locked at the $1 mark. That theory imploded in May 2022. During a mass sell-off, the algorithm couldn't keep up. The peg shattered, and the entire system collapsed in a matter of days. The result was the destruction of $45 billion in a single week. The industry's ultimate safety net proved to be its most dangerous trap. Even if the coins are volatile, investors assumed the exchanges where they trade were secure. At the top of that infrastructure sat FTX, an exchange so massive it had stadium naming rights and multi-billion-dollar backing. Its CEO, Sam Bankman-Fried, was hailed as the White Knight of crypto, a figure representing the trust and maturity the industry supposedly needed. In reality, FTX was secretly funneling customer deposits to a sister hedge fund to cover risky bets. When the house of cards fell, investigators found a total absence of corporate controls, with billions of dollars simply missing. This is the ultimate irony. A movement designed to escape the control of central banks ended up centralizing its power in an unregulated, fraudulent exchange. This is the hierarchy of failure. A base currency with no utility, a market full of dead coins, a safety net that destroys wealth, and an infrastructure built on fraud. After every collapse, the community asks how this could happen in an anonymous, unregulated industry, yet the cycle of pump-and-dump schemes continues without interruption. When you strip away the technological promises, you find that the entire industry is driven by the same human greed that has fueled every financial bubble in history. While blockchain technology may eventually find a transformative use, its current application in crypto remains a giant casino where the house always wins. The grand promise of a decentralized future has become a digital mirage that vanishes the moment you reach for it.